Trump's 2025 tariffs and Elon Musk's political moves, Tesla, Uber, and market volatility explained. Asia-Pacific markets mixed after Trump delays tariffs to August 1, market impact analysis. Trump's 2025 tariffs and Elon Musk's political moves, Tesla, Uber, and market volatility explained. Brace yourself, global markets are caught in a whirlwind of chaos, and the stakes couldn't be higher. President Trump's bold tariff moves and Elon Musk's audacious leap into the political arena are shaking up industries, rattling investors, and creating a roller coaster of risks and rewards. If you're wondering how to navigate this storm, you're not alone. This article dives deep into the turbulence, unpacking how these seismic shifts are impacting giants like Tesla, Uber, and entire sectors sensitive to trade policies. Stick around, because we're about to reveal not just the dangers, but also the hidden opportunities, and trust me, you don't want to miss this. The global stage, Trump's tariffs and their far-reaching waves. Let's start with the elephant in the room. President Trump's tariff policies, rolled out in 2025, have sent shockwaves through the global economy. These measures, which were controversially deemed illegal by courts in May 2025, are under intense legal scrutiny, with critical deadlines looming on the horizon. For instance, July 9 marks a significant escalation of tariffs targeting China, while July 31 is the date to watch for the appeal ruling on the so-called fentanyl tariffs. These dates aren't just calendar markers, they're potential turning points that could either stabilize or further destabilize markets. The economic fallout is already measurable. Experts predict these tariffs could shrink U.S. GDP by nearly 1% and wipe out over 1 million jobs by mid-2026. Industries like car manufacturing and shipping are feeling the heat directly, with higher costs and disrupted supply chains. Meanwhile, sectors like technology and pharmaceuticals are bracing for their own challenges, as investigations into their practices loom large. Imagine you're a small business owner in the auto industry. Suddenly, the cost of imported parts skyrockets, squeezing your margins. That's the kind of real-world impact we're talking about here. Tesla, Elon Musk's political play and its price tag. Now, let's zoom in on Tesla, where things are getting, well, messy. Elon Musk, never one to shy away from the spotlight, has thrown himself into the political ring, opposing Trump's big, beautiful bill and even launching his own political faction, the America Party. But here's where it gets controversial. While Musk's political ambitions might energize his base, they're wreaking havoc on Tesla's stock. Investors are jittery, and for good reason. Here's a breakdown of what's driving the chaos. EV tax credit / Musk's public feud with Trump has had tangible consequences. The U.S. government has axed electric vehicle (EV) tax credits for domestic manufacturers, stripping away a key pricing edge Tesla once enjoyed. This means Tesla cars are now more expensive for buyers compared to competitors who might still benefit from other incentives. Brand backlash. Tesla's reputation is taking a hit, with its favorability rating plummeting to just 32%. Why? Musk's alignment with polarizing political figures has alienated some of his customer base. Imagine being a Tesla fan who suddenly feels uneasy about the brand's direction. That's a real risk for the company. Innovation stumbles. On the operational front, Tesla's much-hyped robotaxi trials in Austin have disappointed, with the stock barely budging, up just 0.5% after the launch. This suggests investors are losing faith in Musk's ability to deliver groundbreaking innovation while he's distracted by politics. The result? Tesla's market value has nosedived by a staggering $280 billion since the start of 2025, more than the entire worth of Ford. Analysts are sounding the alarm, warning that Musk's political adventures could drag the company down further if he doesn't refocus on running the business. And this is the part most people miss. Tesla's woes aren't just about tariffs or politics, they're about leadership priorities. Should investors hold on, or is it time to jump ship? We'll circle back to that question later. Uber, rising above the storm with smart moves. While Tesla struggles, Uber is quietly stealing the show, proving that not every company is at the mercy of tariff turmoil. Uber has positioned itself as a powerhouse in logistics, leaning on strong profits and cutting-edge partnerships in autonomous vehicles, AVs, to weather the storm. Let's break down why Uber is thriving. Solid financials. In the first quarter of 2025, Uber's revenue soared by 14% to $11.5 billion, with profits hitting $1.8 billion. Its delivery business, which makes up a third of its revenue, grew by 18%, outpacing its core mobility segment's 15% growth. These numbers show Uber is not just surviving, it's thriving, even in a volatile market. AV innovation. Uber's partnerships with AV leaders like Waymo and WeRide are paying off, with autonomous rides now accounting for 20% of trips in Austin. What's brilliant about Uber's approach is its asset-light model, meaning it doesn't own the vehicles, so it avoids direct tariff hits. Instead, Uber earns fees by facilitating rides, a strategy that keeps it nimble and profitable. The payoff is clear in the stock market. Uber's shares have skyrocketed by 55% in early 2025, and it's trading at a price-to-earnings (PE) ratio of 16, which is a bargain compared to industry averages. Analysts are bullish, setting a price target of $89.81, suggesting there's still 21% upside potential. For investors, the takeaway is simple. Uber's strong fundamentals and forward-thinking AV strategy make it a safer bet than Tesla. If you're looking to dip your toes in, consider buying in gradually when the stock hovers between $75 and $80. Tariff-sensitive sectors, where risks meet rewards. But here's where it gets interesting. While tariffs are a threat to many industries, they're also creating unexpected opportunities for savvy investors. Let's explore two key sectors. 1. Semiconductors. On the risk side, proposed 25% tariffs on imports from China and Taiwan could hammer this sector, raising costs and disrupting supply chains. But there's a flip side. Companies like Taiwan Semiconductor, TSM, and NVIDIA (NVDA) could bounce back strongly if trade tensions cool off. Imagine a scenario where a new trade deal is struck, easing tariffs and boosting these stocks overnight. That's the kind of opportunity to watch for. 2. Logistics. Tariffs on maritime equipment, some as high as 100%, are causing chaos in global shipping. Yet, US-based logistics firms like FedEx, which have diversified their supply chains, are poised to outperform. These companies are less vulnerable to tariff shocks because they've spread their operations across multiple regions, reducing reliance on any single market. And here's a quick note on exchange-traded funds, ETFs. The SOX ETF, which tracks semiconductor stocks, has dropped 15% in 2025 due to tariff fears. But if trade deals materialize, it could be a prime candidate for recovery. The lesson here? Volatility isn't just a risk, it's a chance to buy low if you time it right. Your game plan: how to thrive in the chaos. So, how do you make sense of all this and protect your investments? Here's a step-by-step strategy to navigate the turbulence. 1. Steer clear of Tesla, for now, until Musk shifts his focus back to innovation and operational excellence. Tesla remains a risky bet. Its 21% stock drop year-to-date is a red flag, signaling it's too exposed to political and geopolitical drama. 2. Lean into Uber. With its strong profits and AV partnerships, Uber is a standout performer. Its current valuation makes it a compelling buy, especially if you're looking for stability in a stormy market. 3. Target tariff-proof tech. Look for semiconductor giants like TSM and NVIDIA, especially during price dips. Bonus points if these companies have ties to US manufacturing, which could shield them from tariff fallout. 4. Stay alert for key dates. Mark your calendar for July 9th, tariff escalation, and July 31st, court ruling on fentanyl tariffs. These events could trigger sharp market shifts, creating opportunities to buy or sell. The bigger picture: winners, losers, and what's at stake. Stepping back, the clash between Trump's tariffs and Musk's political ambitions has created a market full of contradictions. Tesla is stumbling under the weight of its leaders' distractions, while Uber is soaring by staying laser-focused on execution. Entire sectors are reeling from tariff threats, yet within that chaos lie pockets of resilience and growth. The key for investors is to zero in on companies with solid fundamentals and exposure to game-changing technologies, like autonomous vehicles. In times like these, patience and careful analysis are what separate those who thrive from those who merely survive. And here's a bold thought to chew on: could Musk's political gambit actually be a long-term win for Tesla, if it positions the company as a champion of certain policy changes? Or is it a reckless distraction that could sink the company further? This is where opinions diverge sharply. Some see Musk as a visionary playing a high-stakes game, while others see him as a liability. What do you think? Final words of wisdom. The data paints a stark contrast. Tesla's political overreach has made it a pariah among investors, while Uber's disciplined focus has crowned it a leader in the logistics revolution. But here's the kicker: none of this is set in stone. Tariff policies could shift, Musk could pivot, and new trade deals could change. Asia-Pacific markets mixed after Trump delays tariffs to August 1. Market impact analysis. Here's a twist no one saw coming. Global markets are in a tizzy over a calendar shift that could reshape trade dynamics for years. While most eyes were on the clock ticking toward July 9, U.S. President Donald Trump casually upended the script, pushing tariff deadlines to August 1 and sparking a ripple effect across Asia-Pacific stock indices. But here's where it gets controversial. Was this delay a strategic move to buy time for negotiations, or a calculated gamble to pressure trading partners? Let's unpack the fallout. Asia-Pacific markets opened Monday in a tug-of-war between optimism and anxiety. Japan's Nikkei 225 dipped 0.53%, while South Korea's Kospi clung to a 0.19% gain, showcasing the region's fragmented response. Australia's S&P ASX 200 slipped 0.11%, and Hong Kong's Hang Seng Index tumbled 0.61%, reflecting investor unease. The question on everyone's mind: will August 1 become a new battleground for trade talks, or a deadline for chaos? Meanwhile, Treasury Secretary Scott Bessent hinted that the delay might give countries a lifeline to renegotiate terms. "This isn't a fresh start, it's a chance to fix what's broken," he remarked, though critics argue it's a backdoor way to keep pressure on allies. And this is the part most people miss: the real drama isn't just in the tariffs. The Reserve Bank of Australia is set to cut rates by 25 basis points this week, a move that could either stabilize or destabilize markets further. Oil prices, too, are caught in a perfect storm. OPEC Plus nations, led by Saudi Arabia and Russia, agreed to a surprise production hike of 548,000 barrels per day, sending crude prices plunging. U.S. West Texas Intermediate dropped 1.91% to $65.72, while Brent crude fell to $67.50. Analysts warn this could flood the market by year-end, but is that a bad thing for consumers? Should OPEC Plus be praised for prioritizing affordability or criticized for undermining price stability? Back in the U.S., stock futures tumbled after Trump's announcement. The Dow Jones Industrial Average futures slid 0.32%, and tech-heavy NASDAQ 100 futures dipped 0.42%. Yet Friday's U.S. market gains, fueled by banking sector optimism, remind us that volatility is the new normal. So, what's next? Is Trump's tariff delay a bridge to cooperation, or a red herring? And how will OPEC Plus' production surge reshape the energy landscape? Share your thoughts. Do you think this August 1 deadline will lead to a trade détente, or is it a recipe for economic turbulence? The debate is just beginning.